Something happened in the silver market today that most people are going to wake up tomorrow and completely miss. And by the time the evening news gets around to explaining it, if they even bother, the window to truly understand what just happened will have already closed. So stay with me right now, because what unfolded today is not just a price move. It is a signal. And if you know how to read it, it changes how you think about the next 12 months entirely. Silver just moved 6% in a single trading session. 6% in one day. That is not a typo. That is not a rounding error. That is a seismic shift in a market that is already sitting on top of years of unresolved structural tension. And today, something broke loose. The question you need to be asking right now is not just what happened. The question is why, what is underneath it, and what does it tell us about where things are heading? Because when you understand the machinery behind a move like this, you stop being someone who reacts, and you start being someone who sees things coming. Now, before we go any further, if you are new here, this is Element Axis. This channel is built around one thing and one thing only, giving you the clearest, most honest breakdown of what is actually happening in financial markets, using real data, real sources, and real analysis. No hype, no trading signals, no membership pitches, just the kind of breakdown that helps you make sense of a world that increasingly feels like it is operating by rules nobody bothered to explain. If that is what you were looking for, hit subscribe right now and turn on notifications, because this is the kind of content we put out every time markets do something that deserves a serious conversation. And trust me, today absolutely qualifies. So let us start at the top and work our way down, because understanding today requires understanding the context that built up to it. Silver did not just explode 6% for no reason. Markets do not do that. Even when they look chaotic from the outside, there is always a structure underneath. And today that structure had three very distinct pillars holding it up, and all three of them hit the market at the same time. That convergence is exactly what produced the magnitude of the move we saw. The first thing you need to understand is what happened in the legal and trade policy space, because this is the catalyst that lit the fuse today. The United States Supreme Court issued a ruling that struck down a significant portion of the trade measures put in place during this current administration. The court determined that the president had gone beyond his constitutional authority by using emergency powers to impose sweeping reciprocal tariffs and selective import duties across dozens of countries simultaneously. This is not a minor housekeeping decision. This is a fundamental challenge to how executive trade power has been exercised. The court's reasoning was grounded in the basic constitutional principle that the power to tax, and tariffs are a form of taxation, belongs to Congress. The executive branch had stretched its limited scope well beyond what existing statute allows. On paper, you might expect that ruling to reduce uncertainty. You might expect markets to breathe easier, knowing that some of the more aggressive trade measures were being walked back. But here is where things took a turn that nobody in the mainstream coverage is connecting properly. New tariffs are being rolled out under different statutory authorities. Existing tariffs justified on national security grounds remain fully in place. And the net result of a court ruling that was supposed to limit tariff power is that global effective tariffs have actually increased, now sitting at 15% as a baseline worldwide. Think about that for a moment. The legal check that was supposed to slow things down has actually produced an escalation. And when you are sitting as an investor, a business owner, or just someone trying to protect the savings you have spent a lifetime building, that kind of outcome does something very specific to your decision making. It tells you that the rules can change overnight. It tells you that any trade agreement reached today may not be valid tomorrow. It tells you that the people in charge of trade policy are operating in an environment with no clear ceiling on how far things can go. And when that kind of radical uncertainty enters the picture, capital starts looking for assets that do not depend on any single government's decisions or any court's rulings to maintain their value. That is exactly what precious metals are. And today, the market priced in that uncertainty with a conviction that produced a 6% single-day move in silver and a more than 2% move in gold. Gold reached over $5,196 per ounce. But silver outpaced it by a ratio of 3 to 1. That ratio is telling you something very specific about market structure, and we will come back to it. The second driver today was geopolitical, and it is accelerating in a way that deserves your full attention. The United States has moved significant military assets into the Middle East, not token deployments, not symbolic positioning, significant military assets, and at the same time, the president has publicly stated that Iran has somewhere between 10 and 15 days to reach a deal on its nuclear program. I want you to sit with that language for a second. When a sitting president announces a specific deadline for a specific country backed by visible military repositioning in the region, that is not diplomacy in the traditional sense. That is an ultimatum with a countdown clock. And markets understand countdowns very well. A large-scale military confrontation involving the United States and Iran, a country already experiencing serious internal instability, carries the risk of pulling Washington into another prolonged regional conflict, at exactly the moment when American financial credibility is already being tested by the trade policy chaos we just discussed. The combination of trade legal uncertainty at home and military escalation risk abroad creates what risk managers call a compounding scenario. Each factor amplifies the other. Trade war creates inflation risks. Military conflict in a major energy-producing region creates additional inflation risks. Both together create a situation where the case for holding physical hard assets becomes nearly compulsory for a certain class of sophisticated investor. And that class of investor has been expanding for several years. How many of you have been watching the silver market for years, tracking the fundamentals, watching the supply data, and wondering when the price was going to wake up and reflect what the physical market has been telling us for a very long time? Drop a comment below right now if that describes your experience, because what happened today is directly connected to what the physical market data has been signaling for 6 consecutive years. And that brings us to the third driver, which is structural, and in my view, the most important factor of all when you're thinking about silver over any meaningful time horizon. The Silver Institute, which is the primary research body for this industry, has confirmed that 2026 will mark the 6th consecutive year in which global silver demand exceeds global silver supply. 6 years in a row. The projected shortfall for this year alone is 67 million ounces. I want that number to land properly. 67 million ounces. That is not a small imbalance at the margins. That is a structural gap that has been accumulating for half a decade, being papered over by drawing down inventories built in prior years by recycling existing metal, and by some demand being priced out at levels that could not support continued consumption. But those mechanisms have limits. There is only so much inventory to draw from. Inventories on major futures exchanges have dropped to decade lows. A single week in Shanghai saw 43 tons of metal move out of exchange warehouses, which is extraordinary by any measure. These are not abstract statistics. These are physical ounces leaving storage. And the more physical metal leaves storage, the closer the market gets to a point where the buffer is exhausted and price has to do the work of clearing the market on its own. The deficit was always going to force a repricing eventually. What the tariff chaos and geopolitical risk premium did today was pull that repricing forward in time. They gave the market permission to start adjusting to a reality it had been slow to fully price in. For most of the last decade, the conversation about silver demand was dominated by solar panels. That story is real and ongoing. Even though individual panels require slightly less silver due to efficiency improvements, total volume consumed by the solar industry keeps growing because installations are expanding faster than the per-panel reductions offset. But the growth story in silver demand has shifted toward 3 areas tied deeply to the technological priorities of every major economy right now. The first is artificial intelligence infrastructure. The build-out of data centers to support AI workloads is happening at a pace that would have been difficult to imagine 5 years ago. These facilities require massive quantities of specialized electrical components and materials capable of handling the thermal demands of high-density computing. Silver, because of its exceptional electrical and thermal conductivity, shows up throughout these systems. This is a demand category that essentially did not exist at meaningful scale before the current AI investment wave. The second growth area is electric vehicles. EVs use significantly more silver than traditional combustion engine vehicles, primarily in electrical systems, battery management architecture, and the charging infrastructure that needs to scale alongside vehicle adoption. Every major economy is pushing EV transition with subsidies, mandates, and infrastructure investment. The third area is advanced semiconductor manufacturing. The chips powering modern computing, defense systems, and AI hardware all require silver in their fabrication processes. As geopolitical competition has driven the United States, Europe, and China to each invest heavily in domestic chip capacity, demand for the materials those fabs require has grown alongside it. None of these demand categories are cyclical in the way traditional industrial demand is. They are driven by technological transitions and geopolitical imperatives being actively accelerated by government policy across multiple competing superpowers simultaneously. When those superpowers are all racing to build AI capacity, EV manufacturing, and chip fabs, and all 3 races require silver, you have a demand picture that does not follow the normal rules of a commodity market. Now, what does the technical picture look like? I want to be completely clear before going further. Nothing I am about to describe is investment advice. I'm not telling you to buy anything, sell anything, or do anything with your money. I am showing you how traders and analysts read market structure so you can develop your own framework for evaluation. Silver broke above a key resistance level that had been capping price action for weeks. The breakout invalidates a downtrend and opens the technical path toward higher targets. The moving averages that professional traders watch most closely, sitting in the $82 range, are now functioning as support rather than resistance, which is a meaningful structural shift. When price reclaims its key moving averages and they flip from resistance to support, the technical bias shifts from neutral to bullish in the framework most systematic traders use. Near-term price targets from the current structure are in the low 90s, and then the psychologically significant $100 level that everyone in this market is watching. Strength indicators are showing buyer conviction without reaching the extreme levels that signal a move is overextended and due for reversal. That combination, conviction without exhaustion, is generally associated with moves that have room to continue before needing to consolidate. On the downside, the levels to watch are around $85 as the first meaningful support, and then the low 80s where the key moving averages sit. As long as price holds above those levels on any pullbacks, the structure favors continuation of the trend that emerged today. Here is something most silver analysis ignores entirely because it requires looking at a completely different market. Copper inventories across the major global exchanges have reached their highest level in 23 years. Both copper and silver are industrial metals used in EVs and electrical infrastructure. So you might expect their inventory trajectories to look similar if the demand drivers were really the same story, but they look nothing alike. Copper inventories are at historic highs, while silver inventories are at decade lows. Copper mines have responded to elevated prices with increased output, allowing inventory to rebuild. Silver supply has not responded the same way, because a large portion of silver is produced as a byproduct of mining other metals, meaning its supply does not respond as neatly to price signals. Silver also has a monetary component that copper simply does not share. Central banks do not hold copper. Individuals do not historically buy copper as a store of value. But silver has played that role for thousands of years, and that monetary demand creates pressure on inventories that copper does not experience. If copper, with its building inventories, is expected by major Wall Street banks to rise significantly from current levels, what does the supply-demand math suggest for silver, which has collapsing inventories and a demand profile copper does not share? The relative setup in silver is more compelling from a pure fundamentals perspective. Let me walk through the scenario analysis, because this is how serious analysts approach a market in motion. The bull case for silver projects, prices reaching $100 to $130+ per ounce. The catalysts are continuation of trade policy conflict keeping safe haven, demand elevated, sustained AI and industrial demand growing faster than supply can respond, continued inventory drawdowns, creating physical delivery stress, and geopolitical developments maintaining the current risk premium. In this scenario, the 6-year structural deficit finally overwhelms the inventory buffer and price rises dramatically to ration scarce supply. The base case sees silver trading roughly between $80 and $92, with steady industrial growth, no dramatic escalation or de-escalation of current risks, and ongoing deficits managed through continued drawdowns. Silver moves higher over time without explosive repricing. The bearish scenario sees prices pulling back toward the low to mid-70s. The catalysts would be swift trade tension resolution, a global economic slowdown, successful Iran diplomacy, and new silver supply arriving faster than current mine pipelines suggest. The bearish case requires multiple things to break in the same direction simultaneously, which is considerably less probable than the base or bull cases given the current trajectory. Drop a comment right now and tell me which scenario resonates most with your own read on the market. Now let me spend a few minutes on the broader monetary context, because silver's move today is not happening in a vacuum. The US dollar's share of global foreign exchange reserves has been declining steadily and is now at multi-decade lows. Central banks around the world have been actively diversifying away from dollar-denominated assets and buying gold at a pace not seen in decades. There's a specific reason why this diversification has accelerated. Following Russia's invasion of Ukraine, the United States and allied governments moved to freeze hundreds of billions of dollars of Russian foreign exchange reserves. In a single policy decision, the assumption of dollar neutrality was shattered. Every central bank that held dollar assets watched what happened and drew an obvious conclusion. If your assets are held in a currency that can be weaponized against you based on geopolitical alignment, they are not as safe as you thought. Central bank gold buying has surged to record levels year after year. Gold holdings in central bank portfolios now exceed Treasury holdings for the first time since the 1990s. Silver benefits from the same fundamental dynamic. When trust in fiat currency erodes and inflation persists, capital flows toward real assets. Institutional flows go to gold because of its reserve asset status. But individual investor flows, from family offices and high net worth investors who understand monetary history, increasingly flow into silver as well. Because silver's market is dramatically smaller than gold's, even relatively modest flows can produce outsized price effects. That asymmetry between market size and potential flow is one of the structural features that makes silver compelling to investors looking for leverage to the same monetary dynamics driving gold. The gold to silver ratio measures how many ounces of silver are equivalent in price to 1 ounce of gold. At current prices, with gold above $5,000 and silver around $87, that ratio sits at approximately 60 to 1. In historical periods of monetary stress, that ratio has compressed dramatically. During the 1980 silver episode, it dropped to nearly 16 to 1. During the 2011 silver rally, it fell below 40. If the ratio simply moved from 60 to 40 with gold unchanged, that compression alone would put silver above $130 per ounce. That is arithmetic applied to historical ratio patterns. Whether those patterns repeat in the current environment is genuinely uncertain, but the historical precedent for the kind of moves analysts are projecting means these are not baseless claims. They are arguments grounded in documented history, applied to conditions that rhyme with prior episodes. Now let me give proper time to the risks, because any analysis that presents only the bullish case is not honest analysis. The 6% move today happened in an environment of elevated volatility, and volatility does not care about direction. The same conditions that produce today's upside can produce a sharp reversal. If the tariff situation resolves more convincingly than current trajectory suggests, some of the safe haven bid supporting silver could fade. If Iran diplomacy succeeds, the geopolitical risk premium comes off. If AI infrastructure investment slows, if EV adoption disappoints, or if semiconductor demand softens, the structural deficit picture changes. And higher prices always incentivize new supply eventually. Recycling responds faster than new mine development, which takes years. These are real risks that could change the picture materially. The framework is not about finding one guaranteed outcome. It is about understanding the range of plausible outcomes, thinking honestly about probabilities, and making decisions appropriate for your own situation and your own capacity to weather volatility, regardless of which scenario plays out. I want to say something directly to those of you in the 45 to 55 plus age bracket. You have worked for 30 or more years building savings and the financial foundation that is supposed to support the next phase of your life. You are not in a position to easily recover from a major financial loss with additional years of earned income. The decisions you make about positioning your savings over the next decade matter enormously. The structural arguments we have discussed represent a genuinely compelling case for why silver, as a portion of a diversified portfolio, might make sense, as a hedge against systemic risks that are increasingly visible. But silver is a volatile asset. It moves sharply in both directions and does not pay income. The approach that serves people well is understanding the story deeply, evaluating the risks honestly, deciding what portion of your overall financial picture is appropriate given your individual circumstances, and positioning in a way that allows you to hold through volatility without making fear-driven decisions at the worst possible moments. That is the difference between strategy and speculation. And when the money in question represents decades of work, that distinction matters enormously. If you found this breakdown useful, share it with someone who would benefit from seeing the data and the analysis in one place. The mainstream financial coverage of today will give people a price number and a few sentences of context. It is not going to explain the tariff legal chaos or connect the monetary framework to the physical inventory data to the technical breakout. That is what we do here at Element Axis. Hit the like button right now if this has given you a clearer picture of what happened today and why it matters. Let me bring everything together. Silver moved 6% in a single session, outpacing gold by 3 to 1 to reach its highest level in weeks, above $87 per ounce. Behind that move was a Supreme Court ruling that struck down major tariff powers, followed immediately by an executive escalation taking global tariffs to 15% through alternative legal channels. The result is amplified uncertainty with trade policy, now an open conflict between branches of government. Layered on top was an Iran ultimatum with a 10 to 15-day deadline and significant U.S. military assets positioned in the region, creating a geopolitical risk premium now being actively priced into hard assets. Underneath all of that, and most important for any analysis extending beyond this week, is the structural reality of 6 consecutive years of silver supply deficits, a 67 million ounce shortfall projected for this year alone, inventories at decade lows and declining, and a demand profile that has expanded well beyond solar panels into AI data centers, electric vehicles, and advanced semiconductor manufacturing. The technical structure has flipped bullish on the breakout above key resistance. The gold to silver ratio remains historically elevated, suggesting room for significant silver price increases if it compresses toward prior historical norms. The primary risk scenarios that could reverse the trend require multiple things to go right simultaneously in the bearish direction. What it all means is that informed analysis of this situation does not support dismissing what happened today as noise. Today was not noise. Today was a market pricing and structural realities that have been accumulating for years and catalysts that have now arrived to force the issue. One more thing before we close. Drop your location in the comments below. Are you in California watching these tariff battles unfold with particular intensity? Are you in Texas, where energy and trade policy intersect in very specific ways? Are you in Florida, where the monetary dynamics hit differently for a retirement-heavy population? Are you watching from outside the U.S. trying to understand how American trade chaos affects your own financial position? Drop where you are. Tell me whether you are seeing elevated premiums on physical silver at local dealers, whether availability is tight, whether your financial advisor has even mentioned any of this to you. That ground-level intelligence often surfaces information before it shows up in any official report. And the collective perspective of this community across all those different locations and experiences is genuinely one of the most valuable things about having this conversation in this format, rather than just publishing a static analysis. This is Element Axis. We will be back when the data demands it. And right now, the data is demanding a lot of attention. Stay curious, stay grounded, and make your own decisions based on your own research and your own honest assessment of your situation. See you next time.